Have you ever noticed that things just cost more these days? A candy bar that used to be $1 is now pushing $2. A gallon of gas feels like a small fortune. That, in a nutshell, is inflation. But what is it really? And why does it make your money feel like it's losing value? Let's break it down. Inflation is essentially the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Think of it like this. If something costs $1 today and there's 2% inflation, that same thing will likely cost $1.02 next year. It doesn't sound like much, but over time, it adds up. Now, why is this relevant to us, especially here in the US? Well, inflation impacts everything from the groceries you buy to the rent you pay, the gas in your car, and even future costs like college tuition. It's a key economic indicator, and understanding it is crucial for making informed financial decisions. For the last few years, the US has experienced some of the highest inflation rates in decades, making it a particularly hot topic. So how does it work? The most common way to measure inflation is through the Consumer Price Index, or CPI. The CPI tracks the average change over time in the prices paid by urban consumers for a basket of consumer goods and services. This basket includes things like food, housing, transportation, medical care, and recreation. Economists look at how the price of this basket changes month over month and year over year to calculate the inflation rate. But what causes inflation? There are a few key drivers. One is something called demand pull inflation. Imagine everyone suddenly wants to buy the same thing, let's say, concert tickets for a hugely popular artist. If the supply of tickets is limited but demand is high, the price will go up. That's demand pull inflation in action. More generally, if overall demand in the economy exceeds the available supply of goods and services, prices will rise. Another type is cost push inflation. This happens when the costs of production for businesses increase. Think about the price of oil. If oil prices go up, it costs more to transport goods, heat homes, and manufacture products. Businesses often pass these increased costs onto consumers in the form of higher prices. Let's look at a simple example. Imagine a bakery makes loaves of bread. Last year, the ingredients flour, yeast, sugar cost them $2 per loaf. They sold the bread for $4, making a $2 profit. But this year, due to supply chain issues or increased demand, the cost of those ingredients jumps to $2.50. To maintain their profit margin, the bakery has to raise the price of the bread to $4.50. That's inflation. Now, a little bit of inflation is actually considered healthy for an economy. A small amount of inflation encourages people to spend and invest, rather than hoarding money. It also gives businesses an incentive to innovate and improve efficiency. However, high inflation can be very damaging. It erodes purchasing power, makes it harder for businesses to plan for the future, and can even lead to economic recession. Think about it like this. If you have $100 and inflation is 5%, that $100 will only buy you $95 worth of goods and services next year. Your money has lost 5% of its purchasing power. That's why it's important to consider inflation when making financial plans. There are ways to protect yourself against inflation. Investing in assets that tend to appreciate in value, such as stocks, real estate, or commodities, can help you maintain your purchasing power. Some investments, like Treasury inflation-protected securities or TIPS, are specifically designed to protect against inflation. Diversifying your portfolio is also key. The Federal Reserve, or the Fed, plays a major role in managing inflation. The Fed uses various tools, such as adjusting interest rates, to try and keep inflation at a stable level. Raising interest rates can slow down borrowing and spending, which can help to curb inflation. Lowering interest rates can stimulate economic growth, but can also lead to higher inflation. It's a delicate balancing act. Now, let's quickly summarize. Inflation is the rate at which prices for goods and services are rising, causing a decline in purchasing power. It's driven by factors like demand, costs of production, and monetary policy. High inflation can be harmful to the economy, while a small amount is considered healthy. Understanding inflation is crucial for making informed financial decisions, and there are ways to protect yourself against it through investments and diversification. It's a complex topic, but hopefully, this gives you a clearer understanding of what inflation is and why it matters. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.